You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. Welcome back, everyone. Welcome back to the Young Investors Podcast. How are you going, Hamish?
I'm doing well.
How's things down in Melbourne?
Yeah, things are going well. We're a little bit earlier this week. We had to kind of move a couple of things around. We're recording a little bit earlier, but also later in the day. So we'll do our best to stay as chirpy as we are normally in the morning when we record it.
This is going to be the sleepy podcast. It is currently 4:43 p.m.
Yeah.
that is such a rubbish time to record a podcast.
Yeah. So not only are we going to be tired by the end of this podcast, we're going to be hungry as well. So
yeah,
we'll see how the end of this goes. I might just start getting angry about whatever story we're talking about. But
do you get hangry? Do you get hangry often?
Oh, yeah. Doesn't everybody? Yeah. I think everybody does.
Yeah,
at
I
least
think so. I get so hangry, man. If I'm hungry, just don't even talk to me.
Yeah, exactly.
Talk to me if you got like a burrito or something, but if you don't, then stay away. Oh gosh.
Oh dear.
But even though it's late in the afternoon, we still should have a pretty good show for this week.
Yes.
We got some things to talk about. Elon Musk is just setting the world on fire as per usual.
Oh boy.
There's a lot to unpack there. We got more details on Rivian's IPO, and you got a story about AMC, so the movie theater. Be interesting to hear how they're going. And Apple. The Apple versus Epic Games controversy continues, I guess. And I hope that we'll get a chance to go through some Q&A. We've got some good Q&A questions to get through. I pre-screened a few of them this week, and some of them are really quite good. So hopefully we get a chance to do some questions at the end as well. But we'll see how we go. Should we get stuck into it?
Yeah. Today's episode is sponsored by Sharesight, which is an application that you can use to track the performance of your stock portfolio. So basically, you can bring in all of your trades either automatically or you can enter them manually, and it will allow you to track all of the different types of gains that your portfolio experiences. So capital gains, dividends. If you have dividend reinvestment plans, it will do all of those calculations for you. Currency gains, if you're buying shares internationally or you hold foreign currencies, that one is super important, especially if you're someone like us who invests overseas into the American markets. You need to make sure that you're tracking the difference between those two currencies, as it can have a dramatic impact on your actual return. And then you can also use it for when it comes to tax time. So Sharesight generates up to 12 now different reports that can be used at tax time to work out things such as capital gains, dividend income, and more. And at the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That site spelled SIGHT, sharesight.com/young investors. Use that link, sign up to a free plan, and try it for as long as you want. But you can also use that link to sign up to a paid plan and get 4 months off a yearly subscription, 4 months free on a yearly subscription. So go check it out if you're interested. One other thing I thought we should probably mention just up front was if anyone didn't see, we did a live stream on, when did we do it? It was Sunday last week, right?
Yeah, I think so. Yeah, Sunday afternoon. Yeah. That was great. What a good time that was. I had a lot of fun doing that.
Yeah. So what was it? It was investing with Tom and a bunch of us that have teamed up for Movember to raise funds for men's mental health and suicide prevention. We did a live stream last Sunday, which is now a week ago now that you're hearing this. But I thought I'd mention in case you hadn't seen it, there should be another live stream, I think, tomorrow from when this comes out. We won't be on that one, but some of the other members of the team will be, and then there'll be more live streams that we do throughout the month. So we'll leave the links to donate. If you can support, then we would very much appreciate it. If you could donate to our team, Margin of Safety is the team name. So we'll leave the links on the YouTube version if you want to or can donate. Would really appreciate that. Thought I'd just mention that.
Yeah, absolutely. Hey, I got an interesting story today, just off the top of my head. I went to, do you guys have Costco in Melbourne?
Yeah, we do. We have a couple.
Do? Okay. Well, I think we've got one in Canberra. It's out near the airport. And I think I went there once, like a long time ago. But I don't go there because I don't have the membership card or anything. But my friend he shops over at Costco, so I decided just to go with him. And it was actually so much fun just walking through Costco. I was so surprised. I thought they literally just sold just bulk food items, like kind of like a supermarket. But they had like iPhones in there. They had refrigerators. They had like you could buy a washer and a dryer, and they had a flipping restaurant. We got this massive pizza for like $15.
Yeah, how good is the pizza? It's like, it's $15 and it's just a gigantic pizza. And I swear you can't buy pizza like that in Australia. Whereas I feel like in the US that's kind of the norm of like a large would just be a massive pizza.
It was huge.
So yeah, and you can get these massive like sushi platters and all kinds of stuff there. Yeah, Costco's great. It's just a fun kind of experience, I think. It's just so different to every other shopping experience, which kind of why people are so attracted to it.
Yeah, so you know Costco as the place that does bulk things, but man, I tell you, when you see some of those bulk items, you're like, holy moly. Like we're walking through the alcohol section, they have like the 6-liter bottles of vodka. And I'm like, oh my God. But like, yeah, like what you were saying, the massive things, 48-piece sushi platters and like salad things, it's just so like the massive packs of donuts and Danishes. Like, oh my gosh. To be honest, like I kind of thought no wonder like Australia and the United States are like statistically very, very fat if places like Costco exist. Because man, there was a lot of bloody food in that Costco. But man, it was cool. I had a lot of fun actually. I thought it was really cool.
Yeah, I feel like
I got to go look into Costco now.
Yeah, I feel like I would get a membership and shop there more frequently if there was kind of one a little bit closer to me. There's one not too far. It's probably like 20 or 25 minutes away, but even still, kind of having the convenience of a supermarket like really close to your house, I think is really important.
It still wins, doesn't it?
So, yeah.
But it's also like you're the wrong demographic. Like I don't think Costco's targeting you. They're targeting like families.
Big family.
Like you just live there in your apartment, you know? How you 2-bedroom apartments, like how much food do you eat? You don't really need all that much stuff, I guess.
Yeah, I don't eat all that much, so.
Yeah, exactly. Anyway, that was my fun little adventure to Costco. What should we talk about first?
We have to talk about this Elon Musk story first. Because this is
it has been
insanity.
Talk of the town, hasn't it?
Oh yeah.
So if you've been living under a rock, I will explain what has happened. Pretty much, Elon, guess what? He's been tweeting again.
Surprise.
And he was, it's just mind-blowing, isn't it? Elon Musk tweets something. No, he's, this is on November the 7th. He put up this. So what was that? Sunday. He tweeted out, this is what it said. It says, much is made lately of unrealized gains being a means of tax avoidance. So I propose selling 10% of my Tesla stock. Do you support this? And there was obviously a poll, yes or no. And then in a I don't know, sub comment on the thread, he said, I will abide by the results of this poll whichever way it goes. And the poll finished and 57.9% of respondents said yes and 42.1% said no. So if he goes by, if he holds to his word, holds true to his word, then he will be selling 10% of his Tesla stock.
Wow. That's amazing.
Which is, pretty bonkers. And guess, did you see what happened to Tesla stock today?
Yeah, I did. I saw, so there was 2 days, right, that in between, that have happened for us so far, in between the poll. So the first one, I think, was relatively moderate. It was like 4 or 5%, I think, right?
Yeah. Yeah.
And then,
that's right.
And then what happened last night? Last night was a lot bigger, but I didn't see it.
12%.
12. Wow.
Boom.
Actually, the most important thing here is, Brandon, how did you vote in the poll?
I voted no.
I did too.
Sorry?
I did too.
Oh, did you? Yeah. Well, I don't know. Of course people are going to jump on him, say, yes, you should be selling. But I don't think he needs to. I'm not of the opinion that people should be taxed on unrealized gains.
Yeah. That makes perfect sense. Especially.
I just don't, yeah.
Yeah, especially when it comes to something like Tesla, where you could argue that a lot of that unrealized gain is maybe and, if a lot of that unrealized gain went away, it wouldn't be overly surprising, I think, for something like Tesla. So taxing unrealized gains on stocks that, often don't reflect, the value of those businesses now, it doesn't really make a lot of sense, I don't think. But yeah, I don't know. He can do whatever he wants. I just don't think, I said no simply because, I don't know. I don't think he should be, I don't know. I didn't want to contribute to him being forced to do something he didn't want to do. But I guess, he's putting it out there. So, but it also didn't surprise me that the majority said yes as well, I guess, at the same time.
No, that didn't surprise me at all. It's just such an easy, if you don't really understand it, it's such an easy train to get on. Yes, we should be taxing all those billionaires with, heaps of stock holdings. Yes, we should tax them in any way we can. But, when you understand it a little bit deeper, then most people come to the conclusion that actually it doesn't really make a lot of sense. But anyway, so I checked, I was watching the insider trading, and there's not showing, I couldn't find anything. There's no sale as of yet. I imagine, we'll see that in the next little while. I don't think he's going to dump 10% of his Tesla stock at once. I think he's going to do that slowly. Hopefully, fingers crossed.
I think Tesla stock would go down a lot if he just dumped. Imagine if he just puts in a sell order, $25 billion worth of stock.
However many billions of dollars worth.
Oh my God.
Jeez. That would be nasty.
He just does an at-market order. The stock would actually go to zero, I think, if he did that.
That would make me cry. I would actually cry.
And Tesla's gone.
Yeah, see you later. But anyway, so yes, no sales as of yet. But this is kind of the conclusion I came to from what I was reading, and I think this is definitely true. I don't actually think this sale of his Tesla stock has anything to do with Elon's Opinion on unrealized gains and tax avoidance.
Sneaky Elon.
Yeah, I do not think that he cares whatsoever. I think that is a kind of good PR, social justice kind of way to spin you selling 10% of your Tesla stock. But I don't believe he actually cares about that. I think he just wants to sell 10% of his Tesla shares while the price is extremely high. And I will now describe why I think that. So this is from a CNBC article. CNBC notes, Tesla CEO Elon Musk faces a tax bill of more than $15 billion in the coming months on stock options, making a sale of his Tesla stock this year likely making the sale of Tesla stock this year likely regardless of the Twitter vote. Musk was awarded options in 2012 as a part of a compensation plan. Because he doesn't take a salary or cash bonus, his wealth comes from stock awards and the gains in Tesla's share price. The 2012 award was for 22.8 million shares at a strike price of $6.24 per share. Tesla shares closed at $1,222.09 on Friday. Well, they're not there anymore, but we'll run with it. Meaning that the gain on his shares totals just under $28 billion.
Wow.
It says it's quite ridiculous, isn't it? The options expire in August of next year, yet in order to exercise them, Musk has to pay the income tax on the gains. Since the options are taxed as an employee benefit or compensation, they will be taxed at top ordinary income levels, or 37% plus the 3.8% net investment tax. He'll also have to pay the 13.3% top tax rate in California, since the options were granted and mostly earned while he was a California tax resident. Combined, the state and federal tax rate will be 54.1%.
That's just insane.
That is insane, isn't it? That is bonkers. So the total tax bill on his options at the current price, again, this is a couple of days ago before this drop, would be $15 billion.
Right. So in other words, he has to basically sell some of his stock in order to cover the tax bill for compensation that hasn't kind of vested yet, I guess. That was from 2012. That is now kind of expiring. So he has to execute them.
Yeah, exactly. For those that don't know, Elon Musk is extremely cash poor. He actually, I think his brother asked him for a loan, and Elon had to turn his brother down because he didn't have the cash. He is the wealthiest person on the planet, but it's all tied up in Tesla stock, in SpaceX stock, of which if he wants to access all that cash, he has to sell. And obviously, if he gets a big fat tax bill, he will have to sell some of his stock to be able to pay that off. But you might be wondering, well, hang on, didn't you just say that the options expire in August next year? Can't he kind of just delay it? Because I think America's tax year ends in December, doesn't it?
Yep.
But this is another point, and this is what people are talking about now. Why would he sell now? It says the current top tax rate on long-term capital gains is 23.8%, but Congress is poised to vote in the next few weeks on adding 8% surtax on income above 25 million starting in January.
Okay.
So the potential for a surtax gives Mr. Musk and others who are considering whether to exercise options or sell appreciated assets an incentive to do so now.
Right.
The tax difference between triggering roughly 23 billion of compensation this year as opposed to next year could be nearly $2 billion.
Whoa. Yeah. Makes sense to do it now then. I wonder if that will kind of incentivize anyone else who has a lot of stock that they want to get rid of to just do it now and kind of avoid that extra 8% income tax above 25
I'd imagine
million.
so.
But yeah, that's very interesting because I mean, of course, Musk lives in California, which I believe has the highest state tax, particularly for extremely wealthy people. So yeah, 54%.
I think technically he's moved to Texas, but
that's right. Yeah.
But for like all of this, when he earned these kind of options, he was in California.
Right. Yeah. Well, there you go. Yeah, I mean, it kind of makes sense that there was a more, I don't know, tax accountant reason behind why he was going to do that rather than just a Twitter poll. Did seem a little erratic at the time, I think, but yeah, that explanation makes a lot more sense. Yeah.
But then, I mean, for those that kind of don't read it into this sort of depth, then it makes Elon Musk seem like it gives him a good look, you know? I don't know. I just asked people on Twitter whether I should do it. They said yes, so I went ahead and did it, you know? But in actual fact, he was probably going to do it anyway because he had a bucket load of tax that he needed to pay.
Yeah. The funny thing is going through and just going onto that poll and just looking at the comments below it are just so funny. Like some of the comments are just, but just pay your tax. Like completely goes over their head the fact of how unrealized gains work and the fact that he does pay tax. He just has he doesn't have any salary. So it's I don't know. It's kind of funny going through some of those comments, but yeah, we'll see. I mean, I guess he'll probably have to. I mean, of course, he'll have to spread this sale over an extremely long period of time. But that's a big sale of stock.
It's a big chunk. He owns 23% of Tesla. So
yeah, I think
Tesla's divided up into about 1 billion shares.
Yeah.
You would. Yeah, I think is 1 billion, right? Because because the market cap is $1 trillion when the share price is 1,000.
Yeah, that's right.
Yeah. So there you go.
Yeah, there you go. Very interesting.
There you go. Hey, I've got one more little thing to add on to this story, which is actually causing a bit of controversy. You know, listen to this. Kimball Musk, Elon's brother, sold a lot of his Tesla shares before the poll went up.
Insider trading. Did
you see this?
No, I didn't actually. That's crazy.
Yeah. It says here, Kimball Musk made nearly $110 million by exercising Tesla stock options right before his brother Elon spent the weekend asking Twitter users whether he should sell a big chunk of his stake in the EV company.
This is why insiders have to be so careful because even if that isn't insider trading, even if, let's just say it's a coincidence, he didn't even speak to Elon, we'll give him the benefit of the doubt. Even if that's the case, it looks really bad.
It does look bad, doesn't it? Yeah. It says, according to a filing with the Securities and Exchange Commission, Kimball Musk, who serves on Tesla's board of directors, exercised his option Friday to buy 25,000 Tesla shares at $74.17 a piece. He immediately sold those shares along with 63,500 others in tranches ranging from $1,223 a share to $1,236 a share to make about $108.8 million, according to the filings with the SEC that was made public Monday afternoon. And for context, so between 1,223 and 1,236, and Tesla's stock price currently is $1,023. So we'll see. We'll see what's going on, if there's any funny business. But to be honest, it could be a total coincidence because Kimball Musk does sell quite frequently.
Yeah. Well, I mentioned, I think we spoke about it maybe last year, how I think the Pfizer CEO or one of the Pfizer executives sold a lot of, or purchased a lot of stock just before one of the announcements of one of their trials, and the stock shot up like days after that happened. And what happened in that specific situation was what a lot of executives do is they put in their trades many months in advance, and they use a third-party team to make those trades for them, so that if there is a weird coincidence like there was in that case, it was just a coincidence that he was scheduled to buy a bunch of stock, execute some of his options or whatever it was, and then the stock shot up. So when there is a coincidence like that, they can say, hey, I already scheduled this in months in advance. There's no insider trading going on. So there might be something like that happening with this. But I don't know. We'll kind of have to wait and see. But you would imagine, Tesla stock, for those who like to speculate on the short term, you'd have to imagine it's going to be tough over the next few months. I mean, I don't know what Tesla's volume is normally like how many shares go back and forth, but
look it up.
$20 billion worth of shares being added to the sell side, you would have to imagine is significant. Plus, if more people are selling speculatively based on that, I don't know. I guess if I was forced to make a bet about what the stock's going to do, you would think it would be negative, but I guess no one really knows in the end. We'll have to see. But
daily volume is around like 100, kind of between 100 million and 200 million shares.
Right. Okay. So, quite a significant amount. So,
yeah.
Yeah.
I mean, there'd definitely be a right way and a wrong way to sell 10% of his stake in the company. So I just hope he does it the right way. But anyway, so that's kind of the story behind Elon Musk's week. Jeez. I can't say I like him as a Tesla shareholder. I can't say I like him saying these things on Twitter that can influence the stock price. It's pretty brutal. Like, I'm still obviously up by a lot, but imagine if you bought Tesla stock like last week, you'd be crying right now. You're already down like 20%.
Yeah, crazy.
If you bought last week, argument could be made that you maybe had it coming to you a little bit. Anyway, that's enough about Elon Musk. Tell me, what have you been looking at? What have you been researching this week?
Yeah, where should we go? Maybe we can talk. There's a bit of an update around Apple and its court battle with Epic Games. So a few months ago, earlier in the year, Apple was in a court battle with Epic Games over the whole Fortnite fiasco. Basically, Epic Games changed some of the code in their Fortnite app that allowed people to bypass the 30% commission going through in-app purchases, which is, of course, against Apple's terms and conditions for developers. They then banned Epic Games, or they banned Fortnite, and then I think later they banned the rest of Epic Games apps, and essentially starting a court battle about whether Apple was able to do that. And then a bunch of other things as well. There was 10 different counts that they ended up battling over. And there was only one count that Epic Games actually won, which actually forced Apple to allow developers to link to alternative payment websites. So, Fortnite wasn't able to actually allow people to pay a different way in the app, but they could provide a link to, say, the Fortnite website, and you could just pay there so that you could avoid the fee. That was the one count in which Epic Games beat Apple. So the news this week was that Apple was appealing for a stay, which would delay the changes. So the changes were set to go through in December, which is coming up. Apple wasn't necessarily appealing the change. They just wanted it to be paused until all of the appeals for the entire case had been settled. So as I mentioned, Apple won 9 out of the 10 counts. So Epic Games is actually challenging and appealing a lot of those 9 counts. And Apple is kind of saying, hey, well, while you're busy, making us go back to court and fight these, we shouldn't have to make the changes. So this week they tried to get that done, and the courts were having none of it. They denied it. They said that, no, you can make the change in December. So they're forcing them to make the change, as scheduled, and then the other kind of things that are being debated will kind of continue on over the next couple of years, because these court battles go on forever. They go on for years. So, if there are appeals back and forth, I mean, even if Epic just makes 2 or 3 appeals in a row, that could be a couple of years that some of these counts are going to go for. So. Apple unfortunately lost that. The courts were pretty brutal in not agreeing with Apple. They said that Apple's motion is fundamentally flawed. So I guess it was.
It's probably not what you want to hear, right?
Yeah, a bit of a Hail Mary, I think, out of Apple to try and just try.
So Epic Games are trying to get some of these other 9 flipped around the other way. And so is that right? And then Apple were just like, well, if we should wait until this is settled completely before we do anything. Is that kind of what's happened?
Yeah, exactly right. So there's a number of other ones. I mean, as I mentioned, one of them was that Epic Games wanted to be able to actually add another payment option in the app. That was denied. Epic Games wanted to be able to create a Fortnite app store. They wanted to be able to have their own app store, so not just the Apple App Store. That was also denied. So there's a lot of different things that Epic Games was trying to challenge and is continuing to challenge, trying to say that Apple has a monopoly in these certain areas, and therefore these restrictions shouldn't exist. But yeah, big change coming through. I mean, the news isn't really around the change. The change is already, scheduled to come through in December, and it's going to be big. Well, I guess we'll have to wait probably until, halfway through next year, maybe even a little bit longer, to see what the impact is on that segment for Apple, whether people really will be, I think we were talking about this last time, whether people really will take the option to click a link and go to a website and then pay just to avoid, or to pay a little bit less, or will people choose the convenience and just continue to pay through Apple in-app purchases?
Yeah.
I guess it kind of depends on the cost of what you're buying. I guess if it's like a $2 purchase to remove ads, you're likely going to continue to do that through in-app purchases. Whereas maybe if it's a Spotify or a Netflix subscription or a Disney Plus subscription for $110 or something like that, then maybe
you want to save money.
Maybe then you're more likely to take the link and go that way. So.
Yeah, I'm just scared of when Apple come out with their smart home, and then the key card, when you key card to get in, you insert your credit card and it takes 1/3 of your paycheck just to get into your house. That's gonna be rough.
Oh, lost your keys? We can let you in.
Oh God. They just start taking a 30% cut on everything.
Yeah.
They're big enough. They'll control the world one day.
Yeah. No, like
30% tax on everything.
You have everything kind of tagged. All your items in your house are kind of tagged, and you have cameras everywhere. And when you lose an item, Apple kind of knows where it is, but you have to go through a paywall to find it. Oh,
yeah.
Lost your phone. I know where it is.
Yeah. Hold up your credit card to your car door just to be able to enter. Oh, we'll take a couple bucks for that. Thank you.
Or just watch 5 ads and then we'll.
Yeah, exactly. That'd be the Facebook alternative or the YouTube alternative, wouldn't it?
Yeah. You sit there and watch 10 minutes of ads, and then you can drive your car petrol free or something like that.
You seen what I think is the pilot of Black Mirror? Is it the pilot, or maybe not the pilot? Maybe no, I don't think it's the pilot. It's one of the other episodes where it's just like this guy, and he's in this like this box, which is his room, and it's just the whole walls just come up with they're all screens, and they just come up with ads, and it's like, to skip this ad you must pay $1 and something, and it's just like really loud. It's like you can't avoid it.
Yeah,
I was like, gosh, is this what advertising's going to turn into?
Yeah, I vaguely remember that episode. I don't think it's the pilot, but I do remember that episode. So. But yeah, I feel like that's I mean, can definitely imagine a world where if VR does take over considerably, that it's just chocked full with ads.
Can you imagine they should be like, oh, you're listening to the Young Investors Podcast. If you want to skip this ad, please swipe your card. That'll be $1.50. You're like, no, don't do that to me.
Did you see recently?
Gosh, that probably I'm sorry, Andrew, if that absolutely destroyed my audio just then.
Did you see recently the guy who invented pop-up internet ads was apologizing?
Oh, was he? I thought you were going to say something like he was thrown in jail or something.
No, he just came out and apologized because they're just so annoying. And at the time, I think he probably thought, wow, this is so great. This is going to be fantastic for advertisers. And now it's just horrific. There's nothing
Although
worse.
In his defense, if he didn't do it, someone else would have.
I mean, that's true. But my God, there is nothing worse than going on and reading an article or something like that. And there's just like laggy pop-up ads. At least at least if you go on Instagram or just like a social media website or YouTube or something like that, at least the ads are they're crisp, right? It doesn't take away from the experience too much. Like, do you know what I mean? Whereas sometimes you go on like a news website and there'll be like a pop-up like video ad that's just in the corner and like you can't click the X and you try and click the X and you go to the website. Like that experience is just so irritating. Whereas I don't find
the worst.
Yeah, I don't find myself too irritated by a YouTube skippable ad. You know what I mean? Like it's not ideal. Like you're watching a show and you get interrupted, but at least it's a crisp kind of easy, I don't know.
I get annoyed by unskippables. They're annoying.
Yeah, back-to-back unskippables as well is...
Back-to-back unskippable ads are pretty rage-inducing.
Yeah, they should just always give you an option to skip because even if it was like you can skip after 15 seconds, I feel like rather than no skip for 15 seconds, I feel like you would just... It kind of makes you feel a bit better. That like there's a point. Yeah. It gives you something to do. You can like look at the countdown and then be like, okay, I can...
I'm sure there's a science behind this.
Yeah,
I'm sure somebody's figured it out.
Yeah, someone's
optimization. Yeah. All right. But anyway, that's interesting. Is that all we've got to talk about for Apple?
That's all we've got. Where do you want to go from here?
I've got a quick one. There's nothing too much to talk about because we've already kind of dived into this before, but the Rivian IPO. Oh, yeah. I just wanted to circle back because remember how they were trying to price their IPO? Originally, they were trying to get the valuation of 80 billion and then back to 50 billion. You remember that we were talking about that like last month or two?
Yeah.
It says here now that Rivian Automotive Inc. priced its highly anticipated IPO at $78 per share, well above its raised expectation, valuing the electric vehicle maker more than $77 billion on a fully diluted basis, according to, here's your favorite line, according to a person familiar with the matter. There it is again. Man, we've hit so many of those in the last few shows.
Why do they need that line for that? Isn't that just a fact? Like what the value of the business is based on its shares? Like why do they need to say like allegedly? They're basically saying allegedly.
They are saying it's weird because this is, I don't know, this was breaking news and it was a Wall Street Journal exclusive. So I don't know if maybe something is yet to be confirmed. But yeah, the way they wrote this article definitely seems like it's a set in stone thing, and CNBC are now reporting the same thing. So
it's weird.
Yeah, I'm not too sure about that. But yeah, it says the company backed by Amazon.com was expected to raise about $12 billion in the offering by selling more shares than originally planned. The amount of shares to be sold was still moving around late Tuesday, a person familiar with the matter said, so that number could change. So it seems like maybe this isn't set in stone yet. Rivian said on Friday that it aimed to sell shares at a price $72 to $74 a piece, up from its initial targeted range of $57 to $62.
Oh, I see. Okay, so have they not gone public yet? So this is kind of still leading up to their IPO. Right, okay.
Still the lead up.
Yeah, so I guess they can change the number of shares that they offer or the price that they're aiming to sell it at, which, that makes more sense. Yeah, so I guess it's kind of, we're getting a little bit closer to what they're expecting to IPO at, what value. So, yeah, wow. So
they started at 80, they went down to 50, and now it looks like they're back up to 80 billion valuation.
Wow.
And to be, I don't know. God. It's current market conditions, they'll probably get an 80 billion valuation, and the IPO, the shares will go up like 30% on the first day or something stupid.
Yeah, probably.
That's just the way of things at the moment.
That's the world of IPOs at the moment.
Yeah.
80 billion. Is this the company that made like 12 trucks or something? Or is that a different?
Yeah, delivered 12 trucks in Q3. Yeah.
God, I could make 12 trucks. I swear.
Yeah, give me a shot.
Give me a go.
If somebody said, hey, bro, if you make 12 pickup trucks in the next 3 months, I'll give you an 80 billion valuation. I'll be like, I'm going to try as hard as I can to make those 12 trucks. I will recruit every single person I know with any sort of automotive experience, and I will make 12 trucks.
I will personally sign every truck. I will.
Yeah, I'll do whatever. Yeah.
I don't know.
If I knew that I was going to get an 80 billion valuation, I would make 12 trucks in the next 3 months, regardless of what it took.
Yeah, we'd get there. We'd get there for sure.
But yeah, there you go. Rivian IPO.
There you
Hopefully
go.
we actually see it fairly soon.
Yeah, talking about speculative stocks, I've got a little bit of news around AMC this week, which is a little bit of a non-story, but it kind of made me kind of circle back to AMC because it's always fun to just keep up to date with these stories and not just forget about them, because the hype, there's always a period of hype, and for AMC this was in the middle of this year, and then everyone just kind of forgets about it and the story just ends. Whereas I kind of want to keep up to date with these things over the next year or so, the next couple of years, and just see what happens. See what happens to the end of these stories, because there's been a lot of hype around AMC over this year.
Yeah.
Earlier in the year, so over the past 5 years, the stock has been terrible up until this year. It fell from $35 per share in 2015 was its peak since its IPO, to $1.91 in late 2020, which is an incredible decline in a stock. It then surged to $63 in June this year. There was a lot of institutional investors shorting the stock, pushing it down, and it attracted that wave of Wall Street bets investors or speculators, gamblers. Investors. That
don't they call themselves like degenerative gamblers or something like that?
Yeah. So at least they know.
Degenerates. I don't know, something like that. That's actually their words, not mine. I can't remember.
No, exactly. So so a lot of them, piled into the stock, caused it to short squeeze and surge up and get up to $63 per share. And the company was actually able to then raise capital by selling shares at a higher price and avoid bankruptcy. So it really, funnily enough, this kind of event that you would think should be isolated to just the stock market. It's just a trading event, really, between two types of traders. It ended up actually having a real impact on the business. They were able to sell shares and get enough money.
It's so funny, isn't it?
It's just, it is kind of ridiculous though, right? I mean, but you do kind of forget, I think, what the stock market is for, because once the company sells shares, most people, when you're buying shares, you're not actually giving money to the company. You're just trading shares between other people, right? It's kind of like it's just a marketplace for people who are, essentially betting on the value of shares. So it's easy to kind of disconnect what the stock market is to the underlying business. But, an event like this kind of shows you what the connection is, which is, the stock market is an ongoing way that businesses can access capital. And for businesses that are in desperate need of capital, an event like this is great. It's good for them. But
absolutely,
today the stock is at around $40 per share with a market cap of $20 billion. So while the meme frenzy, of course, has kind of driven the stock over the past year, the next decade of performance will depend on the performance of the underlying business. So it kind of turns back now to, okay, this is what the market is valuing the company at, $20 billion. What can the business actually do from here? It's all good and well what it's done over the past few months based on, a trade that people were able to identify, but what's the business actually going to do? And that kind of brings us to this week. Management is talking about whether the business can get profitable by the end of the year, because they're still not profitable coming out of the pandemic.
Right.
Management said that if they can hit $2 billion in box office sales in Q4, they will be profitable. They're going to That's kind of their goal. And that would mean that they'd have to get to 75% of what it collected in Q4 of 2019. So they don't have to get back to, as good as they were performing prior to the pandemic, but 75% of the way there. And they will be just profitable. So that's kind of what's going on with the business at the moment. There's kind of a debate about whether that's achievable. I think they did in the first month of that quarter, they did about 700 million. So they would have to do about 1.3 billion for the remaining 2 months. So they would have to match October. But apparently it looks quite difficult. Q4 of 2019, which they have to kind of push up into and kind of get close to, had some big title releases. They had the Joker coming out, Frozen 2, Jumanji. It was a Star Wars movie that came out. So, there's a lot of debate about whether they'll even get to that point and get to be profitable by Q4, which is something they desperately need because, again, they're going to continue to, run out of money, of course, if they can't get profitable.
That's a good point, actually. Now that you mention that, so much of their success actually comes down to the studios releasing their movies. And I still think there's a hesitation. I think we're starting to see it come back now. There's probably the biggest release recently has been the new James Bond movie.
Yeah, probably.
But so hopefully that's kind of a trigger that we'll start to see the big name movies coming out again in the cinemas. But that's really, I didn't even think about that. They could be doing all the right things, AMC, and people can be allowed to be back at the theater. But if studios still aren't putting their titles out there yet, then they could suffer because of it.
Yeah, and I mean, studios have this ever growing problem of where do they allocate, capital for projects? So they allocate more towards television series for their growing streaming platforms that they need to put a lot of money into at the moment to get, a strong competitive position. Or do they balance it, or they just continue to spend even more every single year on at the box office? It's difficult, but I mean, it's a bit of a non-story, really. I think just management saying we can get profitable, we'll just get there. But it reminded me to kind of reflect on AMC and just have a look and just see, okay, well, how's the stock looking now? And the stock hasn't, to its credit, hasn't collapsed after the big short squeeze. I think it got up to 63. It's now at 40, so it came back a little bit, but it's well above the $2 that it was at the end of last year. 20 times higher. So, the question is that justified? As I said, can the business, perform to reflect that? I looked back over the past 10 years and, they're unprofitable 5 out of the last 10 years. Their most recent year of profitability was 2018. They did 110 million in profit. So I just took that and just said, okay, well, what if they get back to 2018, right? The current stock price is 180 times earnings, which is, and there's, more shares outstanding now than there was back then. So it's probably even a little bit higher than that on a per share basis. So yeah, I look at that and I just think, wow, I mean, I wouldn't pay 180 times earnings for a company growing at 40% per year. But you have this company and, I don't know. I don't see it growing substantially in the future.
Yeah. You can just tell that the people that are in it right now they don't care about the business. They're just playing the short squeeze game. That's all they're doing. Yeah.
And I mean, if that is the case, which seems like that's what it has to be, right? If that is the case, then where's the breaking point, right? Because there has to be a point at which the stock price, or you would think that there has to be a point at which the stock price has to reflect what the business is actually producing or what it's capable of producing, let's say over the next decade or until it no longer exists. So yeah, as I said, I want to keep watching this and keep up to date with it every now and then and see, if that breaking point comes over the next couple of years or whether the stock just stays at 200 times earnings for the next 10 years. Who knows? I don't think that's going to happen.
It's an interesting one.
Yeah,
very interesting.
We'll have to see what happens.
The thing that makes me laugh about these stories, like with GME and AMC, is the fact that the squeeze happened and then they raised capital. That's just the funniest thing in my mind.
Yeah,
it's like, well, we may as well while the share price is high.
Yeah, it's crazy that they can do that. And
it is pretty funny.
Hertz wasn't allowed to do that, right? Hertz was too close to bankruptcy, I think, where they the surge in the stock price was just that didn't make any sense. But yeah, it's kind of crazy, but it's not surprising, and good on them for taking advantage of it.
Yeah. There's a lot of companies that have done. I mean, even Tesla's stock price 10x'd itself, and then they're like, we're just going to raise. They're like, what are you raising for? I think they said, for balance sheet strengthening.
Yeah.
Which is pretty much a sure sign that they're just raising because the stock price is high.
Yeah, and I think, was it Michael Burry who was saying that Tesla should just issue like 3 times the amount of shares or double the amount of shares that they had? They should just take full advantage and just get a bunch of cash and go crazy on investment capital they could spend. I don't know. That
would have been so interesting.
It would be.
I mean, it would have been an absolutely crazy move, because you can argue it both ways. But you could argue that if they raised 25% more shares, sold them, then they would, obviously the share price for business versus business performance is extremely overvalued. So they would just have all of this cash, and there's such a hunger for those Tesla shares. So it's just like, man, they could put themselves in this ridiculous position where they could absolutely like smack all the other auto manufacturers around. They could put a gigafactory wherever the hell they wanted on it in every country on earth, and just be like, we are the kings.
Yeah, they issue a bunch of shares, raise a couple $100 billion in cash. I don't know if there would even be the liquidity for that, but they do that, and then they set aside 30 billion or whatever so that they will never go bankrupt. So that doesn't matter if the stock price collapses after that. The stock price will probably collapse because they've diluted the shareholders, but then they can invest significantly in the future of the business, way more than any other business could. And you would think that would be the best long-term strategy, but I don't know.
Honestly, it'd just be an interesting case study if they did that. I would just be so interested to watch it play out. I'd probably be a bit annoyed because I don't know if they could spend that amount of money that effectively, but who knows?
Yeah, I guess that's the other point as well, right? It's like it's one thing to have the money, but then the ability to spend it effectively. Whereas if it comes in slowly over time, year after year as earnings compounds, then you can slowly ramp up your team that is associated with allocating that capital. Whereas if you just suddenly got 300 billion and you're like, right, we've got to build 50 new
let's go
new assembly lines. Where do we put them? Yeah,
it's kind of what we get annoyed with big businesses, like really top successful cash flow businesses now, is that they're kind of just like, they don't really know what to do with their money because they've kind of run out of great investment opportunities. So they're just doing like buybacks at crazy prices and stuff like that. And we're kind of like, well, it's not really the best use of your money, but I don't know, if you really think you've got nothing better to spend it on, then I don't know.
It's the best they've got in some cases.
Yeah. Anyway, should we do a few Q&A questions?
Yes. Yeah, we should. Have you got some lined up for us?
Yeah. How about I'll ask this one here. Let's see.
All right.
Oh, hang on. I'll ask you this one.
Okay.
Not sure when you record the shows and if this will make it to the next one, but I have a question. Well, it's made it to this episode. I'm not quite sure when this question was left. What do you consider to be our main advantages by being long-term focused individual retail investors?
Yeah, I think that's a good question. I think there's a number of advantages I think you have as being, let's just say, an individual retail investor, especially with a long-term mindset. But one main thing is that you don't have clients that are constantly on your back about the performance of your fund versus all of the other comparable funds. It's a big reason why most fund managers kind of just follow the crowd and just move with everyone else, because it's an industry of professionals, and a lot of other industries, you don't want to be caught as being the professional that has different advice from the crowd, because if that advice turns out to or that action turns out to be worse than the crowd, then you can be in a little bit of trouble. So you end up getting fund managers that make decisions with that in mind. And that often means that they're making short-term decisions based on things that really don't affect you as a long-term investor. So as an individual retail investor, you can use those opportunities to invest in great businesses when there's some kind of short-term problem going on that the fund managers have to get out of the stock because every other fund manager is, and that's driving the stock down. But you as an individual, you can just hop in when it's a little bit cheaper and you can just wait. You can wait for, the big institutional money to flood back in when things get positive again. So I think that's kind of one, I guess. Did you have anything to add on that?
Yeah, I was just going to focus on, that corporate structure. I mean, all these funds are just like, they're businesses, right? They got to make their money. And as an asset manager at one of those funds, you've got your boss who's watching over your performance. And then the fund's got all their investors. And, you could be, your fund could even be like, yeah, we're a long-term fund. We're investing for the next 20 years. So hope you're okay with that. And then all of a sudden we have a massive market crash and, you go against the grain and, you're making different moves to the other fund managers that are going to be great moves in the next 10 years, but, they might not play out for another 10 years.
Yeah.
And then, your boss might be like, yeah, that's a great move. We're going to, we're a long-term fund. But if all your investors are like, hey, what the hell? We're suffering losses. We just want our money now. Why aren't you making money now? And they start withdrawing their money, then all of a sudden the boss is like, oh my gosh, we got to change our strategy,
Yeah.
So
I think,
it's just a problem with the system. It's a problem with the system. Whereas, like what you say, there's no pressure on us. We can do whatever we want, and we're also nimble. We're very, very nimble because we don't have millions or billions of dollars that we're shifting in and out of positions. We can just get in and out whenever we want. Like there is no way we're going to sell. We're not going to cause enough volume to disrupt the share price. So we can do whatever we want, whenever we want, pretty much.
Yeah. One other thing I just remembered I just wanted to mention was that, funds have a significant conflict of interest in that they want to have as much assets under management as possible because that means that they're making the most fees. So the result of that is that they always want to, and this is most funds, always want to accept more client money. But the truth is there's not always investment opportunities. And this is, something that Nick Sleep, who was a very successful investor, 20% over 12 or 13 years, he figured out a way around this was that he didn't really care about maximizing his fees. What he did instead was he would just close the fund off, not accept new money when there was no opportunities. And then on the rare occurrence when there was an opportunity, maybe every year or every couple of years, he would open the fund and say, hey, we've got an opportunity. Give us, we're taking more money. If you're an existing client and you want more, you want to invest more, you can. If you're a new client, you can invest. And they would take money, they would invest it. And when they'd filled out the position, they couldn't invest any more in that, or it'd be too big of a percentage of the portfolio, they would just close the fund again. And that's actually the only way that a fund could operate and be a value investor, I think, without, limiting their percentage returns. Because that's just another thing to keep in mind is funds are always investing a growing pile of money, and that means that they usually just stick it into, 200 different companies all the time, regardless of their prices. So, All right, I'll ask one of these to you. Sure. I'll ask this one. In Phil Town's rule number 1, Phil says that there are 2 reasons to sell. The 2 reasons to sell is when a business is priced above its sticker price. This contradicts what I've been hearing, which is to hold for years. I'm curious which approach you take. Love the show.
Yeah, I think this is, it comes down to what, I don't know. I don't think there's a right or wrong answer to this, to be honest. I mean, there are some people that, quite rightly so, see a stock go above its fair value. And if they hold that stock, they'll say, you know what? It's above its fair value. If, law of averages or whatever will say that, if it's above its intrinsic value, if it's above its fair price, it's more likely to come down than go up. And they'll say, you know what, I've made a profit. I bought it below intrinsic value and now it's above. So I'm going to take that profit. I'm going to sell. And that's a fair way to go about it because, hey, you're a great investor if you make a profit. I mean, sure, the stock price might go up after you sell it, but you've still made a great investment. You bought it below intrinsic value. You sold it above intrinsic value. So that's perfectly legitimate. the other way to look at it, and this is what I've heard a lot of, like all the time when I listen to interviews, lectures, read books by, the world's best investors, one of the definite recurring themes is that they cut the flowers, they cut the flowers before, they cut the flowers and water the weeds.
Yeah.
They should just be, and they sell too quickly. Whereas, they say if they had their time again, they would let their profits run. You might have heard that before. If you got a profit, let your profits run. So there's two kind of ways to think about that. I mean, I used to be of the opinion that, as soon as it goes overvalued, I would sell. And I did that a couple of times, and I made some good investments because, it's a good investment. You made a profit. But there was also a few where I sold and it just kept going up and up and up, and you end up feeling really bad because you just think of what could have been, hindsight. So now I'm more in the camp of letting profits run.
Yeah.
But that's just me. I don't think there's a wrong answer.
No, I think that makes a lot of sense. I think especially what you said about you don't want to cut the flowers and cut your returns short if you have a really good business. If you're doing value investing right, and let's say you're using Phil Town's method right, then you should be coming up with a pretty conservative, a pretty safe, a pretty low ball value of what a great business is worth. And your sticker price will be based on that. So I always think, don't be surprised if a great business exceeds your expectations, right? When we're buying a business, you want to be very conservative on what you think the business can do in the future so that the price that you're paying is very, very reasonable and you can be very confident in it. But if the business then quickly exceeds that value, then I think you shouldn't be surprised by that. But with that said, I think, I don't know, the way that I think about it is I probably wouldn't in most cases sell a great business just to hold cash, because even if its stock price is expensive, it may still offer, as I said, it might exceed your expectations, or even under your models, it might still return some percentage returns, which will be better than cash. But if there is a way better opportunity, so if I have one stock that's gone up a ton, but I have another one that I think is really cheap and offers a much better return, and I don't have cash around to invest in that business, then in that circumstance only, I think I would probably move money out of one and into another. But for the most part, you want to be stockpiling ownership in great companies. And I mean, every now and then, I mean, if you have I think like Walmart did, 10 years after it listed, it did 50 times its money. So, if you hit on one of those, and not every business you invest in will be a Walmart or an Amazon or a Costco, but if you just hit one of those and you let it run, then whatever else you did in your portfolio doesn't matter. So you would,
Yeah.
I think Amazon, I think Monish was talking recently on one of his Q&As that he sold Amazon after it went up like 20% or something. And
yeah, he bought it at 10, sold it at 14.
So 40%, I guess. And then after that, it went 330x to today. So, I'm sure that's probably an example of, Amazon stock looked cheap at, after the .com crash. It would have very, very quickly reached its full value and started to look expensive. And we know Amazon, it's been a high multiple to earnings for an extremely long period of time. But that's a business where you could have got it cheap on a valuation basis, and then it just exceeded expectations wildly. And if you held on to it, nothing else mattered in your portfolio. If everything else in your portfolio went to zero and Amazon was 5% of your portfolio, you still probably beat the market by 3 times or something. So
yeah, exactly. Probably more than
probably more. Yeah, exactly.
No, I think you raise good points. All right. I am going to ask you this one here. Hamish, have you considered using your cash position to sell puts? You do great analysis on your businesses and you know exactly what your buy range is. You could make steady incremental gains by selling puts in businesses you love at prices you are willing to pay. You either get cash or you get shares at a price you want. This is interesting. This is an idea that was first brought to my attention by Phil Town. This is what Phil Town does. You can kind of gauge what his buy price is by what he sells his puts at, which I think is really interesting. I was kind of like, oh yeah, that does make sense.
Yeah, I think there's a couple of things here. One is that, the stock's price has to be relatively close to your buy range for there to be put options that you can sell. So that's the first thing. I don't believe there's many available on Australian businesses either, but on US businesses, big ones, there's, considerable volume for selling put options, but it has to be relatively close, right? If the stock price for a business is 100 and my buy range is, 30 to 60, there's not going to be any put options that I can buy. The stock would probably have to be, within $10 per share or something like that, within a reasonable percentage for me to be able to sell them. That's the one thing. The other thing as well is there is, they're not risk-free, right? Of course, great businesses, their stock prices can go down for short-term problems, and that gives us an opportunity to buy them. But stock prices for businesses can also go down if something damaging happens to the business or something fundamentally changes. And I think a really good example that happened to me personally recently was with what happened with ASOS, right? Their business, the stock price had been going down for a long time for reasons that I thought were short-term reasons. But then the stock price collapsed, I think, 10% strictly because the CEO stepped down. And that's a fundamental change to the business. And, would I have been happy if I was selling put options on that stock? Would I have been happy to buy the stock at a lower price, after the CEO had stepped down? Well, no, I wouldn't have. I probably, as I'm doing right now, I haven't invested more in the company. So there are circumstances where, that strategy can end up costing you, particularly if a stock moves down a lot very quickly. But I mean, look, I haven't really looked into the strategy deeply myself. That's kind of my thoughts on it.
Yeah. Yep. I agree. That is a risk, definitely, if something fundamental happened and the stock price tanked because of it. And then you're like, well, I'm now the proud owners of shares I thought I wanted.
But I no longer want them.
I don't really want them anymore.
Yeah. And you could be locking in an immediate loss because you might have a strike price that's, let's say the current stock price is 35, your strike price is 30. That's what you will be forced to buy it at. The stock might fall to 20. So that means you've bought stock at 30. Yeah. It's currently 20 and you don't want to hold it because it's not a great business anymore. So what do? You have to lock in that, whatever that is, a 30% loss then. Or you just hold on to it and pray that it goes back up, but then you're just speculating. So there are circumstances. It's not risk-free, I think. There's just the clear, with everything in investing, there's nothing that's risk-free. Such as just be.
Here's an interesting idea though.
It is.
And I'm not surprised that, it gets utilized quite a bit by big investors because, they can essentially generate income off of, like, if they don't get to buy through selling their puts, they just get to generate income from the stock price being high.
Yeah, exactly. Yeah.
Which is a very interesting concept. But I think that'll just about do us for today. I think we'll wrap it up there.
Yes.
Thank you very much, guys, for listening. We hope that we weren't too boring. It is now 5:45 p.m. and the sun's going down and a couple of yawns are creeping in. But no, we hope you still enjoyed this episode. We'll be back on our regular time slot for recording. So if we were a little bit down today, that should not happen again next week. But yeah, we're going to get out of here. Thank you guys very much for listening and tuning in as always. Thanks, Hamish, for joining me as always. Thanks to Sharesight for sponsoring this episode. And we'll see you guys next week.
See you guys.